Hashem. I am an advisor. What's that? Okay. I am an advisor at WealthSpire, and like it was mentioned, WealthSpire, we are the advisor to your retirement plan. Our role is slightly different than your record keeper, which I think is Empower. Empower serves as the record keeper, so they're going to be where you get like your statements from. They are what like your app interface, where you're going to go on and log into your computer or on your phone. And they're going to be a great resource for transactional items like updating or managing contributions, distributions, loans, login information, those kinds of transactional items. But we're serving here primarily as your kind of best practices for engaging with the plan. So how much should I save? What should I save it into? Maybe you have additional outside assets or more complex financial situation, whatever it may be. How you might just go about interacting with the plan. We are here to help you with all of those questions. So don't feel alone. You have a good team between us as your advisor and your record keeper. We're here to help make this as comfortable or as manageable as possible. And we're going to go ahead and cover a good amount today. So I'm going to, as we're going along, feel free to add questions in the chat. We're going to monitor that so that if anything comes up, feel free to go ahead and throw those questions in there. If I know sometimes it's scary, especially with a big group like this, it's scary to put maybe a question in the chat. So if you don't feel like putting something in there, no worries. We'll have information at the end. So if you want to get in touch with us personally or ask an individual question that pertains specifically to you, right? Because a lot of this is going to be specific to you. Feel free to just reach out to us afterwards or to our contact information. We'll be more than happy to follow up with you individually. So I want to start today by acknowledging something that is important, and that is most people don't get any formal education around personal finance, right? We didn't learn this in school. We're expected to figure it out as we go, trial and error, right? So today really isn't about perfection. It's about clarity, and it's going to be a big kind of 10,000 foot overview of financial success. So we're not going to get into the weeds on every one of these topics. Otherwise, I'll be talking to you for way more than our allotted time. I don't think anybody wants that. But we want today to feel a little bit more like a conversation, not a lecture. There's no quiz at the end, I promise. So hopefully at the end, what we're really looking for is that you feel hopefully a little bit more confident about where you're at. And if not, that's okay. Hopefully confident about around maybe what next steps or practical next steps I can do to engage with my financial success and make moves towards that, towards those goals. So with that being said, let's kind of take a step back, and I want you to ask yourself a simple question of when you think about your finances, do you feel calm? Do you feel stressed? Does it make you feel secure, unsure? You don't have to put it in the chat or write it down, but just kind of be aware of what comes to mind, what kind of comes to the surface. No need to fix it yet, but just kind of be aware of what kind of those thoughts, initial thoughts are. And today we're going to be going through just a simple framework of 6 steps towards financial success. Now, these 6 steps, they work together. They're hopefully designed to meet you where you're at. Everybody's in a different spot. Whether you're just starting out in your career, whether you're in the middle of your career with a lot of different priorities, right? Life's getting more busy, or maybe you're beginning to think of more seriously about retirement. Maybe that's right around the corner. So one important thing kind of as we're going through this, you don't need to have or work on all of these 6 steps at once, right? Financial success is not about doing everything perfectly all at the same time. It's about doing hopefully the next right thing. So that's what we're going to engage with today. And hopefully you'll come away with a little bit of something to be able to take maybe hopefully at the very least that next step towards financial success. So When we first kind of look at our financial plan and the stages of financial plans, most will move through three broad stages. And those stages are protection stage, the accumulation or savings stage, and then your growth and distribution phase. So early on, the focus is usually on stability, protecting that income, figuring out how to manage debts, right? Building good habits, putting together that strong budgeting tool for yourself. And then mid-career, we're working towards growth, right? Saving more, investing intentionally. We have a little bit more. We've built up our expertise. Maybe we're making a little bit more money than we did early on. And so we're able to put a little bit more aside. And then we're starting to come up with additional questions like, how do I manage my taxes? Now that those are starting to, maybe I'm in a higher tax bracket now. How do I go about answering those questions? And then later on, the focus is going to shift toward income, right? How do I replicate my income in retirement? How do I think about longevity of my nest egg, leaving a legacy behind? And there really is no right place to be in this planning scenario, but these are just really stages to kind of put yourself in that are going to be kind of a good pulse check as to where you might be. And we're going to go through what that might look like and just kind of maybe defining where you might be along that scale. Now, the first step to financial success, we like to define it as protecting what you have. And we want to start with the protection phase because everything else depends on it, right? This is our base. This is our foundation, what we build our house on. And protection really is about resilience, right? It's about making sure that one unexpected event doesn't undo years of progress, that unknown, right? Life happens. This includes things like putting together your health insurance plan, your disability coverage, life insurance, liability protection, and just to reflect on this stage here, if your income stopped tomorrow, when you're trying to find, okay, maybe where am I at in this stage? Did I put together the right plan? If your income stopped tomorrow, temporarily, permanently, what would that mean for your household, your dependents? You don't need to solve that today, right? We're building awareness, just kind of level set. Where are you at? But what would that look like? What does that question look like for you? Now, this picture here is going to give you some stats around insurance and some kind of doom and gloom numbers, right, for people feeling maybe underinsured. But the reality is most people don't avoid insurance because they don't care. They avoid it because it feels complicated, maybe uncomfortable, or they don't understand it. So why bother? I'm going to put it off. I'll think about it another time when maybe I understand it a little bit better. But many households really are underinsured, and this isn't by choice, right? It's by default. You don't start out with insurance, you have to choose it over time. And really, when we're choosing over time, we're choosing which risks we can absorb and which ones we can't. And then recognizing that gap needs to be filled and where can we fill in those gaps. And in reality, some risks are really just simply too large to self-insure, right, or pay out of pocket. So insurance does play a major role in protecting and giving that good foundation. And you're protecting that, right, your base. And so we don't want to throw it off, like we said, with one unexpected or the unknowns. We want to be prepared and make sure we're setting up good protection around the base, the foundation of our financial plan. And this raises really the next question. How much coverage do I need? What coverage do I need? And this is going to be unique to everyone. And there's really 6 core areas that show up in most plans. You have medical insurance, long-term care, disability, income, liability protection with things like property and casualty. You have life insurance. And even if you have coverage through work, which most of us do, it's important to understand what you currently have right? I know it seems like a lot when we're going through open enrollment, you're just picking different options, but we want to understand really what we have. And if our employment changed, what would change? If you do, generally it's for, right, if you do end up keeping that coverage through that stage of potentially moving employment, you can potentially carry those on for a short window, but your costs go up. So being aware of those things is important. And so that's why we like to consider maybe purchasing individual policies to add to bolster that protection phase, to enhance and supplement those group insurance coverages at where you might need. And this is going to be different for everyone. There isn't really time to go through all of these in detail today, but to be aware of these different forms of coverage. And really the key here is coordination, right? We're not buying every protection out there, but maybe asking ourselves, what are the biggest needs right now? Like, everybody hopefully should have health and life insurance. And what can I think to maybe think about down the road in this protection bucket? So now that we have protection in place for this foundational step, the next step is really taking control of your cash flow. And we're going to jump into that in a minute. I don't see any questions coming in. Like I said, feel free if you have anything along the lines. We will definitely go through and try and answer those as we can. And then if we get to the point where we're running out of time, I will address those individually afterwards. So I'll keep a pulse check on the chat. Aaron's going to help me monitor that. But just feel free to throw questions in there as we go. So as we're talking about cash flow, when we think about it, and if I saw your cash flow, right, this is the story of where your money is coming from and where it's going. If you don't know your own story, it's very hard to feel confident about any of your financial decisions. Now, if I read your story, I could tell you what your life looks like around your cash flow. So knowing your own story is extremely important. And this step really involves creating a budget, creating a liquidity fund for emergencies. We'll talk about that. How to position that available cash, so it's not just sitting in a savings account at a big bank, and identifying your net worth. So all of those steps are going to come from this cash flow stage. But this step is really easy, and a lot of times people can think, oh, I kind of have a good idea of it, but really we want to make sure that we're starting here being specific, and it's very crucial that we do that. So effective cash management really has three parts. The first part of cash management is to assess your situation. You can't control your spending, right? Like we said, if you have no idea what you're spending your money on, once you see where you have maybe an excess or a deficiency after going through that budget, you can then put those dollars to work more productively. So check in with yourself, build a budget. There's a lot of great tools out there. We can put you in touch with a couple if you are comfortable with budgeting apps or things like that, or if you want to do it manually, that's okay as well. But even if you've done a budget, go back. It's a great opportunity, especially kind of still at the start of the year here after as tax season's kind of going, to check in with yourself, see where you're spending, and check in on that space as we get going. But second, we're going to build a cash reserve. So after we kind of see where those spending habits are, that cash flow process, the next piece is building that cash reserve. And this is your peace of mind money. And we want to think of this as a 3 to 6 months of essential expenses bucket. What we mean by that is any money that you have to spend every month, that's going to go in your essential. And then we want to lean towards that 3 to 6 months or 3 to 6x of whatever that number is. And that's a big window, right? That could be a very different amount. So we want to lean towards 3 months. If you have additional income outside of your own in the household, maybe a spousal income or a partner, anybody else in the home, maybe real estate income, whatever it may be. If you have additional forms of income outside of your own, you can lean towards that 3 months. And then we're going to go ahead and push towards leaning to 6 months if you're really the primary breadwinner in the home or income wage earner in the home. That way, if something were to happen to that form of income, we want to make sure that you're fully prepared. And if there's nothing else to supplement that, we're going to lean towards that 6 month marker. And then third, we want to be paying down high interest debt in this category. So credit cards really are the double-edged sword, right? They can be powerful allies when used right, but they can also trap you into paying a lot of money for items really that lose value over time. And we're going to look at an example of that. But as you're thinking about this, just as a question to ask yourself, if an unexpected expense came up next month, next week, 2 months from now, whatever it may be, would you feel prepared or would you feel pressure from that expense? And so that's kind of a helpful gauge for where you're at with this. And like I said, there's a lot of good tools out there. So if you'd like to have us send you over some of that information or call or talk with us about that, we're more than happy to walk you through that process as well. So talking a little bit deeper about your emergency funds, right? That 3 to 6 months of essential expenses bucket. This bucket, it's really important that the goal of this bucket is to be liquid and stable, right? It's not invested aggressively. This money should be easily accessible and easily depended upon. So these are things like savings accounts, preferably like a high yield savings account, CDs, money market funds. Those things all serve a purpose here. And the job of this money really is flexibility and not growth. Now, preferably, like we said, this is not in a big bank savings account like Bank of America, Chase, where you're gaining really like a fraction of a percentage every year. Where I'm sure if you've done that and you've seen your statement come in, you get 0.03 cents back on the money that's sitting in that savings account. We really want this to be able to be a little bit higher than that, especially when inflation is coming in at 3+% annually. So using the right vehicles here can fill that role of being accessible, but also not losing value over time. Now, which vehicle out of all these makes the most sense for you will vary, and we're happy to sit and talk with you and go through this further. And this is, like I said, just a high-level overview of process and to kind of check in and see where you're at, and we can go through that in a one-on-one capacity as needed. Now, circling back on credit cards, right? The double-edged sword, like we talked about. This is really good, just visual on how interest on these cards can be quietly working against you. Now, in this hypothetical example we have on the screen here, we have $30,000 of credit card debt with an 18% interest rate. Now, if you made $541 monthly payments, which is the minimum, it would take 10 years and it costs a little over $60,000 to pay off that balance and interest. Now, on the other hand, just as kind of a side-by-side comparison, if you were to save monthly at the same amount into an investment or diversified stock portfolio, hopefully, and get an average rate of return of about 8%, that account would grow to almost $100,000 in that same 10-year window. Now, even if the returns are enticing, right? And we don't want you to see this and think, oh, you forget the credit cards, I'm just going to invest this money instead. It sometimes makes, or can make, especially if it's a high interest account, can make a lot more sense to invest in paying off high interest credit cards debt before you make other investments. So pausing your other investments and paying off this 18% rate first, and then allocating all of those extra dollars into your investment after. Because having that 18% high interest debt can really create a big drag on your financial success if you continue to actually draw it out the full 10 years or whatever the term is on those payments. So just a good visual to realize that sometimes that interest can accumulate quickly, and we want to be careful not to be paying for things that are losing value over time and paying more than we should be for those things that are losing value. Okay, I'm still not seeing anything in the chat. Aaron, correct me if I'm wrong. I don't see anything here, but Okay, so we're going to move on to step three. Once cash flow is under control, right, and we have that foundation, we have our protection in place, investing becomes then more intentional instead of reactive. And that's our next step. Investing and investing wisely really isn't about predicting markets. It's about having a plan tailored to you that fits your goals, your timeline, and comfort level with risk. And it's going to be different, right, for everyone. A wise investment for one person or for one of my clients is going to might be too risky for another. So this isn't a one size fits all. This is tailored specifically to you, and invest wisely is going to look different for everyone. But without having that plan, investing will end up being driven by news, headlines, emotions, what your neighbor tells you to invest in, and we really want to avoid that. Now, big picture here, we all know that markets go through cycles, right? It fluctuates, and that's normal. We expect that. The people who tend to do best through the market really aren't the ones who guess these cycles correctly. They're the ones who stay disciplined and true to their plan through those fluctuations. So this chart is showing a handful of recent events and the impact that they had on the S&P 500. And S&P 500 a lot of times is our market kind of indicator, so how the market's doing. So, and that's kind of at the 3-month marker, the 6-month marker, you'll see in that box, in 12 months after those events. Now, the lines are kind of hard to track here. I was trying to look at them, and there's even some of them are, especially since they're similar colors, they can be kind of hard to track. But if you look in that box, which is kind of giving you the 3, 6, and 1 year takeaway at the top from those different events, you'll notice that most of them, even in the first 3 months, bounced back after those events, and the market had already corrected. So the point here is a question to ask yourself when thinking about market stress and how you are impacted by market stress is ask yourself the question of, have my long-term goals changed? And that's why I'm changing my investment, or has just the news headline today changed? And figuring out that distinction is really where having a plan matters. Your plan will give you something steady to come back to when emotions are high. And this is really where that strong foundation, where having a plan, having those goals, having your investments align with your long-term goals will allow you to stay true to those even when markets are fluctuating, and avoid selling when the markets are low and buying back in when they're high again. So just to drive this home a little bit further, even though it feels like sometimes timing the market is really the most important thing, when in reality, time in the market is really much more important. And we're going to see that here with the power of compounding. Compounding is, if you've heard of it, is a concept that happens when returns build on previous returns. So in the chart, you're going to see the same $10,000 lump sum investment in 4 different asset classes. Now, the purple line, leaving the money in cash, if you just were very risk averse, didn't want to do anything, hide it in the mattress, put it in a cash equivalent, whatever it is, you actually lose purchasing power over time. 30 years, or after that window of time goes by, that value of 10,000 has dropped below 10,000, and you can buy less down the road than you could have in the beginning. Now, with all the other asset classes, the $10,000 grew even though you didn't add any money over time. And the longer that investment was in there, you can see that investment really starting to ramp up at the longer that investment is in that asset class. Now, it's the same for all 3, and hopefully you're diversified across them. But the idea is, as you see that the longer that money is in there, the greater it will start to grow in those later years. So starting earlier, even if it's with a small amount, even if you can't keep up with that amount, can really dramatically change your outcomes. And if you didn't start early, and if you're looking at this thinking, well, there's no point, I didn't start early, not the case. even if it's a small amount, try and invest where you can, when you can, and then increase consistently as your budget allows. That way you can take advantage of your dollars in the market. Now, the dips in the market, and good question, right? Like we're doing, is good to ask yourself is, are my investments being driven by my long-term goals, like I set out for myself, or my short-term discomfort? Am I making these knee-jerk reactions when something happens in the news, and then I'm missing out on the bounce back from those news headlines because the news doesn't tell you when to now get back in, right? It's just with coming out with the scary information up front, and you jump out, and then maybe you're going to miss those opportunities that the market drives back up again. So now that we know how to looks like we got a credit card question. Give me 1 second. Credit cards, if I have the cash to pay it off, is it better than leaving it so that I can have a history of payments? Okay, so this is going around the idea of credit score. We should always be hopefully paying off the credit card by a lot of times best to pay it off at the end of the month or within that window, maybe not right away, right? So that you can build the credit card, but we don't want to be incurring those long interest payments. And really, the goal is more so to avoid those minimum payments, which is going to make you susceptible to paying quite a lot more over time. So paying it off as sooner you can, and then really being aware of what those interest charges are, because if they're higher than what you might be getting in investment somewhere else, it's more advantageous to put those extra dollars in the meantime towards those credit card payments before then moving on to your investment. So being aware of those rates, checking in on those is going to be really helpful. Thank you for the question, Teo. Let me know if that answers it. Hopefully that's helpful. Okay, I think that's all. But so moving along here, as we kind of keep going in this investment category, right now that we know to invest, right? We should invest. We want to make sure we're in the market. We're not sitting in cash, and we want to guard against those knee-jerk reactions. We can talk a little bit about diversification. Now, diversification really is one of the most effective, if not probably overlooked, risk management tools out there. And so instead of relying on one single investment company or idea or stock tip from your neighbor, right? Like we said, diversification spreads risk across many asset classes, different industries, different regions. So the goal isn't to eliminate volatility, right? Those ups and downs in the market. The goal is really to make it, in this sense, with diversification, more manageable. So a diversified portfolio really ends up not experiencing those extreme highs or those extreme lows, so that you can actually stay invested and you're not making those big changes. And you're not going to feel quite so much if there's a big dip, or if there's a giant uptick in the market, you're going to kind of get somewhere in the middle there. So looking at this chart here, I know they can be small, the boxes are small, but the boxes in gray are individual asset classes like we just talked about in the previous slide. And then the gold boxes are going to be your diversified portfolio. And in this particular case, it's a 60-40 portfolio, which is really common for when you're in the retirement years. So it might not be this when you're working now, but so this is going to be a pretty conservative portfolio overall. But what we want to see here is that when you're diversified across a lot of different asset classes, unlike the individual gray boxes, you're not going to be getting those extreme highs and those extreme lows. So like, for example, the emerging market, right, you're going to see it at the very top box early on, and then at the very bottom, and then the following year at the top, and then once again at the bottom there in 2013, versus if you're in a diversified portfolio, right, you're going to get that little bit smoother of a ride. And so it's really meant to be more like, you can think of it like a suspension on a car, right? It doesn't stop bumps from happening in the road. It's not to say that you're going to eliminate all risk in the market. That's not what it does, but it's hopefully going to make the ride just a little bit smoother, a little bit more tolerable. And we'll talk about that more in a minute. So when I am diversifying and when we're thinking through this and we're building our own diversified portfolio, what do I invest in? How do I diversify? What are these different mutual funds I have to choose from? What are ETFs? And these really, those two tools are really going to be a big help when trying to help simplify diversification. So instead of choosing your individual stocks, your individual bonds, those products allow you to invest across many securities at once. What I mean by that is they're professionally managed. Their portfolio managers are managing many securities at once. They're monitoring those investments, and then they're responding to those changing conditions over time for you so that you're not doing it on your own. And then you're flexible to really adjust those allocations, those allotments over time so that they can fit your retirement goals, your time horizon, and your comfort with risk tolerance, since that will inevitably kind of shift or change over time. So instead of just choosing one of the funds that we're going to see next, right, you're choosing a sleeve that has these different funds, essentially mission statement, which you see to the right. So there's a lot of different types of funds. Each one really has a different purpose or different mission statement, right? Now, it's like you're going to see in your current retirement plan when it has like growth fund or income fund or value fund, they're all going to have different mission statements or goals. And those are made up of a host of different securities that are inside those sleeves. So some of them are going to focus on things like stability and income. Others are focusing on growth. And then you might see like a balanced fund where it's going to have kind of a combination of the two. When you're thinking about this, no matter which ones you're picking, none of them are necessarily good or bad. They're just really different tools. They're different roles within the portfolio. And so a big mistake that investors make is not really understanding how the mix of funds that they chose work together. And so if you're doing this on your own, that's okay, but you want to ask yourself, what role does each of these funds or each of these investments play in my overall plan? If you have multiple accounts, multiple retirement accounts, how are these choices interacting with the choices for my other retirement plan? Don't think of them in a silo. Try and think of it as a holistic picture. That way, each piece really will serve their purpose almost as a part of your team, right? And they're all going to be, it's going to make your portfolio a lot easier to understand and be easier to stick with during those times of market fluctuation. So you understand what the goal is, what the purpose is, and what those underlying investments are in your portfolio. Okay, I don't see any others questions come in. Let's see. Oh, never mind, Kara. With the climate of the country right now, is it wise to still invest in international funds? Now, this comes back to, and we can talk with this on an individual basis, right? Because it's not just international funds as a whole, right? International funds will still play a role in our greater port strategy. And we can talk, and this is going to differ for each person, right, based on your risk tolerance. But it is still, right, we're talking about really building out a plan and sticking to it long term, right? So if you pull out when the international fund might not be doing as well, right, we're going to be selling it when it's low, and then if you're looking at it in kind of the rear view mirror and you're saying, okay, now international funds doing well, I'm buying back in again, you just missed that whole window of opportunity that was in there before you got back in. So that's kind of why having a plan and sticking to it and having the outset kind of really is key, so that we're not making those changes and you'll actually end up missing out on a lot of opportunities. So it depends on how much you're in there, and it looks like it makes sense. But yes, good question. I'm happy to chat about that further as well as needed. Okay. So the next step we're going to talk about is taxes, especially right now, right on topic tax season, and how do my investments and how does my portfolio interact with taxes? Now, taxes are one of the largest expenses most people face over their lifetime, but they're a lot of times planned for last, right? Managing taxes doesn't mean avoiding them, right? I think it was Ben Franklin that said a great quote: "There's only two guarantees in life, and that's death and taxes." And so even with that being the case, it being a guarantee, we still want to be intentional about when and how you pay them. And a good plan doesn't eliminate taxes, it reduces surprises. So we'll uncover some of those. I see a couple more questions coming in. I'll answer those next so we can keep the flow here. But some accounts here, and really when we're talking about different accounts, we want to know about how those accounts have different tax implications, and they will. So things like your 401k, your 403b, your IRA, these are all going to be accounts that maybe give you a tax break today, but others are going to give you tax-free income later, like a Roth account. And then you have taxable accounts, right, that offer maybe some flexibility around distributions and don't give fees on top of your taxes when you pull them out, like a brokerage account. So having money kind of in these different tax buckets creates flexibility later, especially in retirement. This is really important. It might seem kind of minimal or maybe even small today, but having those different levers to kind of pull on for income as needed and with different tax implications becomes extremely important. So a good question is, right, to ask yourself, none of us have a crystal ball, but do I know which of my future dollars will be taxed? Is that something we can't answer? And which won't? And why have I picked these buckets and these amounts in them? Or am I just throwing 2% here, 2% here, and not really thinking about it, right? We want to look at what are my taxes like today, and maybe what might they look like in retirement. We can argue in the office, especially over what taxes look like today versus 30 years from now until we're blue in the face, but nobody really knows, right? Nobody really actually knows what it's going to look like that far down the road. But we can speculate, and we can know what we can know is what is our tax bracket today, and based on my income later on down the road, based on my expenses, since I've done my budgeting, I know when my home's paid off. I know maybe I might need only a smaller amount or less than I'm making today, what that tax bracket might look like based on income needs in the future. So we can start asking ourselves those types of questions. And these different tax efficiencies really do compound just like your investment returns. The small differences that you're making or changes that you're making are going to make a big impact over time, and they do affect your outcome. So they don't just apply to income, right? We know that they also apply to investment activity, especially like in a brokerage account. Long-term gains are generally taxed more favorably than short-term gains. You have different tax implications of dividends, interest, capital gains. There's a lot of different things we could talk about. We can't have time to dive into all of these today, but main point that we're driving home is over time, your tax efficiency and those little decisions can compound and make a big impact over time, and you'll see that reflected in your returns and in your distributions a lot of times as well. So let's talk a little bit deeper about your tax deferred growth versus your Roth option, which you have in your account, if you have a tax deferred growth account where you're putting in pre-tax dollars into your retirement account, right? It hasn't been taxed yet, didn't get that little tax bump in the beginning. So a little bit more money. Let's say you're deferring 10% of your income into your tax deferred account, right? And you're not getting, for example, say 10% taxed. A little bit more goes into that account. So it's going to be growing a little bit more each year. And we're going to see that in this slide with the dashed line. And so you'll see that that grows a little bit more over time. And the longer the time horizon, really, the more valuable those tax deferrals become, right? Because the longer those little bits of money have to grow, even though they're small, they do make a big impact. Now, I want to make, I understand that this that this particular graph can be misleading because it's assuming, right, someone's in the 24% tax bracket today and then 24% tax bracket 30 years from now. Now, this is for sake of example. We can't put everybody's tax brackets on the screen, as you would, but more than likely 30 years from now, you probably won't be in the same tax bracket. So even though this graph shows better, right, better outcome for a tax deferred account, if you end up in a higher tax bracket later on down the road in retirement, these numbers could look a lot different, right? You could actually end up with less than if you had put it in your taxable account or a Roth account, right, where it's able to grow tax free and then pull out those amounts completely tax free. Now we can talk about that more as needed, but just as a holistic picture, hopefully this gives a little bit better of an idea of how those interact with each other. Now, last kind of thing on taxes before, and then I'll answer the questions in the chat here. And this is going to apply maybe to some of you, maybe none, or all of you, depending on your charitable tax considerations. But for those giving charitably, planning can really help and enhance in this area. And we want to hit this because it can really help you have a greater impact, right, in those organizations that you're trying to give charitably to, and then also create tax efficiencies for yourself. So there's a number of great strategies to be aware of, right, like bunching donations, gifting your appreciated assets so that you're not paying the appreciated or the capital gains on those assets, coordinating those givings, right, with high income years. And then all of those things really can help increase the efficiency of your generosity. So it's not only just a great tax thing, it can also help you give more, even though it's going to have the same feel in terms of dollars from pulling out from yourself. So this is a great example of how everybody's goals are a little bit different, and really being aware of those goals and where your trajectory is and what your values are can help you build a value-based and goal-based plan. Now, before we talk about saving, I'll check the chat. Karen, is it better to have a home paid off or a home and rental property both with mortgages? Okay, very specific question. Also going to definitely depend, right, on your current situation. So kind of hard for me to gauge without seeing kind of the whole picture. Happy to chat with that one through, Karen, if you want to talk additionally afterwards. I'll be more than happy to kind of dissect that with you, because it depends. The answer is, I guess it depends. At what age or stage should you move out of high risk, aggressive growth and move your retirement fund to a more secure plan that isn't affected by market volatility? Okay. Also, David, it depends, right? But overall, we are wanting to make that transition. There should be a slow, it depends, right? Because if there's not enough, and the reason I say it depends is if there's not enough in your account for a successful retirement, then we don't want to make that change. We need to stay aggressive, because even if we're less aggressive, we're not going to have enough for retirement, and it's not going to be enough to kind of push us through retirement. So we're going to need to stay aggressive. If you have enough, or it depends really on outside accounts, we will maybe start to protect that nest egg, get a little bit more conservative, and talk through some of those additional investments that are going to be more risk averse and pushing towards that. I'm happy to talk through that with you as well individually, so that we can get you the right answer for your particular situation. But it depends. It really depends. So happy to chat that through. Your target date fund, if you're invested in the target date fund within your plan, it will actually do that for you when speaking about your particular retirement plan. So if that helps as a broad answer, that can do it for you or on your behalf. You don't have to think about it. Okay. Talking about saving for retirement. Now, I know this feels like it should almost be at the beginning, right? But really, we can't save for retirement effectively unless we have those original building blocks of that foundation laid. So it's not about hitting a number, right? A lot of times, for whatever reason, a lot of people even get hooked on the thought of $1 million. $1 million all I need for retirement. We don't need to get hooked on any dollar amount or whatever it is, right? It's about building reliable income or future income. So that's why it depends for each person based on, right, their there's living standards, whatever it may be. So you want to coordinate all your savings, your investment, your taxes, your insurance benefits, all within this kind of before planning out that savings for retirement. So having a coordinated strategy so that you don't have accounts that are misaligned with each other and are all aligned with your goals is going to be extremely important. So when we think about retirement savings in a clear way, we want to ask ourselves a few honest questions. And this almost comes back to David's question, right? When do you want to retire? What kind of lifestyle do you want? How long might retirement last? What if it lasts longer? When do I start Social Security? Right? Claiming those benefits earlier or later has a big impact on lifetime income. And those decisions that you make at that point are permanent. So understanding what those options are really ahead of time and what that might look like and what those considerations in different scenarios look like can really create or help create that confidence later on and not create that anxiety that a lot of times comes with the unknown of retirement. So there's a couple of things to think about that are out of your control, right? With retirement planning, we can't control the markets, market returns. We can't control things like policy changes, right? And we can't control life happening, right? There's some out of control, but there are things that are in your control that you can focus on. So instead of focusing on the things that are out of control that we can't really have an impact on, we want to think about things like savings, think about my spending habits, think about diversification so that we can try and control as much of that market risk as possible. And then tax efficiency, right? Making sure that those dollars that we spent so much time saving, we're pulling them out in a tax efficient manner so that we're not wasting and pulling in the wrong order. So the key thing to focus on, like I said, is focus on what you can control. This is not just going to improve the outcome, but really it's going to be a good source of comfort and relief, and not worry about the things that you can't control, because we can only control so many things in our life before kind of the unknown. So we want to focus on those things. Kind of jumping back to what we looked at earlier, time, and this is kind of going back to the compounding, but time is really one of the most powerful tools in retirement planning. When it comes to saving earlier makes a big impact. So start today. If you've been putting off saving until you can put aside your 10 or 15% because you heard on a podcast that's the golden rule, don't wait anymore. Just try starting with 1 or 2%, or go back and increase by 1 or 2%. If you did start there, and make sure you're being aware of where those extra dollars are going. And each of these lines that you see on the screen is essentially depicting that they're saving or investing $250 a month. The green line that you see there in the middle is consistent from day one, but just saved in cash, like a cash equivalent, because they still got 3% or so. They're outpacing inflation kind of barely, or just keeping pace, I guess, with inflation. And so that's kind of worth about the same as it was in the beginning. It's kept pace with inflation, though. Now the blue line saved and invested in a diversified account, earned about 7.25%. But the purple line did the same amount as the blue line, but it waited 10 years to start saving, and it saved that same amount, got the same 7.25%. But you could see the massive difference there. Almost twice as much was able to be saved because of that compounding, or was able to be earned because of that compounding interest effect in time, that value of time, just by missing that first 10-year window. So even if it's a small start today, this isn't to say that if you miss the last 10 years that give up, that's the end, right? Don't miss the next 10, right? Make a small increase where you can, and your future self will really thank you. Start today, and just even if it's small, try and make those small steps towards retirement savings. So now we know, right? We need to start today. or adjust today, depending on if you've already started, but you need to do a little bit more. But where should I save my next dollar? Or my first dollar, right? Where's if you're just getting into retirement savings? But when deciding where that next dollar goes, these priorities do matter. And it's kind of, we want to see this flow. It all starts with building that strong foundation. And part of that first savings priority really should be that emergency reserve. So big enough to fund those unexpected expense spending and income shocks, that 3 to 6 months, right? So we're protecting those additional buckets that we have. So we're not dipping into accounts that have fees. So we're not taking money against ourselves where we might not pay it off. We want to have that funded first or as a priority. And then we want to take advantage really of any company match, right? Get that free money that's on the table where it is. And then unless, right, there's really those high interest loans like we talked about, which if they're higher than what we're expected to get in the market, were those going to be a higher priority? Working towards the max, right, in our retirement accounts or health savings account is next on the list. Sometimes there could be a match on health savings account. And kind of coming back to high interest loans, if you have, even if your market return is a little bit higher, market return is unexpected, right? It's gonna go up, might go down. Next year might not be as good as this year. Your high interest rate loans are guaranteed. Those are going to stay that rate, and they're going to be there. So we want to make sure we're prioritizing those. And then after that, those high yields or the health savings accounts, your additional contributions to your retirement plan. Then we're going to work through things like lower interest loans, and then working towards maxing out our IRA contributions if we still qualify, and then your taxable accounts as needed to give you kind of that extra little bit of liquidity. So panning out, and we're doing a lot fast, but panning out kind of the 10,000-foot view for retirement and what we did think about for retirement income, it's often helpful to put in perspective that in reality, your retirement income is going to come from multiple sources. And the image here, a lot of times used is a three-legged stool that supports you in retirement. You have your Social Security, your personal savings, which are your outside assets or personal savings or brokerage accounts, whatever those may be, right? Retirement, rental properties, like Karen was talking about. And then you have your employer plans or your pension, which probably not as common now, but these retirement plans. So those are kind of your three different legs of your stool, and you're going to lean on all of them in order to have that successful retirement. Now, if you haven't done so already, a big piece here that's going to help kind of tie all this together and fill in those gaps is to check in on your Social Security account. So if you haven't already, please, or if you haven't done it in a while, I encourage you to go to ssa.gov and create an account if you haven't done so, or if you forgot your password because it's been a while. Make sure you get back into that account and see what they say your projected income will be from Social Security, whether you're going to pull it early, whether you're going to wait until full retirement age or longer, whatever it is, make sure you're aware of what those numbers and what those income dollars are going to look like. This is going to be really helpful to define what that gap might be, right? Because you see this green bar of Social Security. If you're only looking at your retirement account and your other expenses or your other bucket of income, we want to define how much of that bar we need to fill up with these other buckets outside of Social Security, and not just lean on Social Security or not just lean on one of these legs. We want to have all three working in harmony so that we're ready for retirement and we're able to bridge that gap. Now, the sixth step, I know we're coming to the end of our time, but just to wrap this up quickly is leaving a legacy, right? You've built this foundation, you've done all these additional things, investing, saving, retirement, income, and it's all going so well, but we want to make sure we're thinking about leaving that legacy for our loved ones, and estate planning really can end up being something that's overlooked, right? Because it might not impact us, but it might impact our family. Once you're to pass away, or if the worst were to happen or you get sick, whatever it may be, we want to make sure that we're aware of this so that at the very least, right, you're doing the basic steps like drafting a will, where we see a lot of people, even if they have drafted a will, it might be outdated due to tax law changes or changes in personal situations, whatever it may be. But so getting these affairs in order, you have tools like wills, power of attorney to be aware of, beneficiary designations, trusts. Those all provide that clarity and control for those later years. And they're not really, I know they can feel complicated, but they're not there to give you that unnecessary complication. They're really there to help reduce that stress for those loved ones and complications that they're going to have to deal with in the future. So the bottom line was with this, if you don't take specific action, right, the estate your heirs eventually receive might end up being significantly less than the one you thought you were leaving them with. And on top of that, your intended beneficiaries, if not set up correctly, of your assets may not end up with what you intended or desired if that is not carefully planned or kept up to date. So if you want to talk through these things further, I know going through this quickly, we're happy to connect with you on these topics individually to provide further education. But outside of just leaving assets, right, we have also the healthcare decisions, considerations. Those are important to be aware of so they're not overlooked. Clear documentation with things like durable power of attorney, living will, HIPAA release, all are going to help to kind of guide your loved ones, your beneficiaries in respect to your wishes and those topics after. So if anyone's had to deal with any of these situations for someone else, for a loved one, for a family member, I'm sure you know how impactful having all of these things in order can be. So in reflecting on this step, just quickly, if you haven't thought about this, you're not behind, you haven't done something wrong, but it can be very helpful to reflect on if, X, Y, whatever were to happen, do I have the right tools in place to guide my loved ones or beneficiaries on my wishes moving forward? And a very simple step here, just as a takeaway at the very least, is to have your named beneficiaries on everything you have already in place today. This retirement plan, your insurance policies, any additional retirement savings vehicles, anything like that, make sure those are up to date and current at the least. And then if you want to talk through these things further, we're happy to do that with you. Now, since we did have a high level overview today of the whole process, I know it can feel like a lot, and it is a lot, right? When we looked at it through a small lens, but we definitely want to stress that financial success is not about perfection. It's always about progress, right? Even a small adjustment or step in the right direction of your goals today can have a big impact for the future. So as we wrap up, I want to start by saying thank you. I know it can be a lot of information in our little hour block of time, but spending this time on your financial well-being is really helpful. And we're just thankful that you were able to step in and be a part of that with us today. If this isn't stuff that's in your wheelhouse, or if you'd like help applying any of these ideas to your specific situation, because all of these are unique, I encourage you to schedule a one-on-one with our team. We're happy to have those conversations, and we're here to support you in this process. You're not alone. We're happy to connect with you and guide you through whether it's engaging your retirement plan for the first time, setting up those things like your budgeting, which are really helpful for the foundation, or having those more in-depth advanced planning conversations as you're getting closer to retirement and you need that maybe additional help because you don't want to worry about this and you want someone to help you with this on a more in-depth level. We can help you with all of those things. So please reach out on this. We have our contact information here. If you want to reach out to our team, this is kind of our hotline number. And then also our email. So you're more than welcome to reach out. You might get a hold of myself. You want to ask for me, you can, or any of our other financial coaches or planners are happy to connect with you. And hopefully this gave you a little something to think about and maybe a step in the right direction. Now, that's all we have for today. I know we're right on the marker here. So I don't think I saw any other questions come in after David's, but if you have questions, please do reach out. And thanks for joining today.
Thank you so much, Ethan. I did add the link to the WellSpire webpage on the Pinellas County website and the additional financial resources page that we put together for everybody. So thanks for joining us, and thanks again, Ethan.
Yeah,
Great info.
of course. Have a great week, everybody.
Thanks. You too.